The most terrifying phrase you could ever hear in financial markets is "this time is different." Today, interest rates are skyrocketing, but they've been here before. Today, the debt to GDP ratio is near 120%, but it too has been here before. Mortgage rates, inflation, unemployment, and bank failures. The list goes on and on. For every macroeconomic factor that seems to forecast doom and gloom, we can say, as a matter of fact, we've been here before. We've come out the other side and we are still doing fine. So the big question is this time different? If you don't know who I am, my name is Joe Brown and I run Heresy Financial University, where I teach active investors how to get higher returns with less risk by learning how markets actually work. Link is in the description below if you're interested in becoming a member. The dominant macroeconomic force that will dictate the next few years and most likely even the next few decades is by far fiscal policy in the United States. If you don't know what fiscal policy is, that's simply the federal government choosing how much to tax, how much to borrow, how much to spend, and where those taxed, borrowed, and spent dollars come from and go to. While the source and destination of those dollars certainly matter, for the purposes today, we're going to focus more on the macro factors, just the raw numbers, because by themselves, those are going to make a big deal. The interest rates on government debt are increasing at the fastest pace that they've increased in a very long time. The 30-year treasury is well over 4% now, for the first time since 2011. There are many factors driving this. Number one, Bank of Japan changing their monetary policy and selling more US treasuries. Meanwhile, the federal government borrowing more, driving interest rates higher. Meanwhile, the Federal Reserve still continuing with quantitative easing and raising interest rates, and many other factors. But it's not just the long-term debt like the 30-year treasury that is getting more expensive. We see this same trend across the yield curve, with the 10-year interest rate being at the same place it was at in 2003 through 2005. The 2-year yield hasn't been this high since 2006 and 7, and the 1-year hasn't been this high since the late 90s. Now, in every one of those examples, we can say, again, we've been here before. Interest rates have been this high. But interest rates are as high as they were in the late 90s and early 2000s. Meanwhile, the total debt that the United States has is much higher. For the long-term debt, the last time interest rates were this high, we had less than 1/3 of the debt we have today. And for the short-term interest rates, the debt today is 7 times larger than it was last time interest rates were this high. So yes, interest rates have been this high before, but it's higher interest rates on a much larger pile of shit. I mean debt. Now, for all of you critical thinkers, you're looking at this and saying, okay, yes, the interest rates are higher, and yes, the national debt is higher, but what really matters is the debt to GDP ratio. Because if GDP is larger, then that means that the government can tax a larger pool of wealth in order to service that debt. So let's take a look. Considering the long-term trend of US debt to GDP, we can see that we are indeed near an all-time high. However, the United States did reach over 120% at the peak of World War II, and we were able to pull out of that just fine. That is 100% true. Unfortunately, we aren't in the same fiscal situation we were in following World War II. When the war ended, we could just stop the spending. Today, the federal government has spent $4.8 trillion to date, which is up 10% compared to the same period last year. Without a war, we don't have our entire workforce stationed overseas somewhere, fighting a war on another continent. This is dollars being spent, yes, on the military-industrial complex, but in ways that they can't just end tomorrow when they've won a war. Similarly, this is money being spent on things that would be political suicide to end, like the entire discretionary budget and the mandatory spending like Medicare and Social Security. And so the reason we were able to deleverage easily following World War II is because the government was able to stop spending all that money on the war. We had a massive productive output increase from everybody coming home from the war and women joining the workforce. And that increase in economic output paired with the government spending less allowed us to deleverage from a 120% debt ratio, which we don't have the ability to do either of those today. Now, in the battle against inflation, inflation, the Federal Reserve has pushed interest rates up to the highest place they've been in a very long time. This is called the federal funds rate, and it is now over 5%, and it hasn't been this high since 2007, preceding the financial crisis. But if you notice on that chart, it's been much higher than that in the past. The Federal Reserve got the Fed funds rate all the way up to near 20% in 1981 to battle the inflation of the 70s. So if the Federal Reserve could push the Fed funds rate up to 20% in the 70s to fight inflation, how is it a big deal that the Federal Reserve is pushing interest rates up to 5% today? Well, keep in mind, at the end of the 70s, the debt to GDP ratio in the United States was only 30%. So the Fed was increasing the cost of the federal government's debt, but it was doing so on a much smaller amount of debt. But debt, GDP, and interest rates are far from the complete story. There are many other factors we have to take a look at. And the next one is tax revenues. We already saw that to date, the US government has spent $4.8 trillion, which is up 10% from the same period last year. However, in a time where we're supposedly supposed to be seeing economic recovery, the federal government has only collected $3.4 trillion in taxes, which is down 11% from the same period last year. By the way, guys, I'm going to be speaking at the Stock Pulse Silver Symposium about the history and future of sound money. It's in Las Vegas from September 29th through October 1st. There's going to be a ton of other great speakers there. There are going to be plenty of opportunities for us to do meet and greet, hang out, get some drinks together. I'd love to meet you there. And everybody who shows up is going to get 1 ounce of silver as well, a 1 ounce silver coin. So I'd love to see you there. There's a discount link, 10% off in the description below. So sign up there, get that discount, and tickets are running out, so sign up soon. And the recession hasn't hit yet. So what is going to happen to federal spending when the recession hits, considering the playbook of the past is to try and spend your way out of the pain? And what's going to happen to tax revenue when the recession hits? It's certainly not going to go up when people can't afford things, are losing their jobs, are selling things, hunkering down, spending less, asset prices falling, which means the difference between the money the federal government takes in taxes and the money the federal government is spending is going to grow even wider at a faster pace than it already is. This is the chart of the federal government's surplus or deficit. If the blue line is above the thick black line, that means the government is running a surplus for that quarter. It takes more in taxes than it spends. As you can see, most of the time it is spending more than it takes in taxes. And as the difference between those two numbers gets worse, this blue line will drop. And every time that deficit gets worse, it makes this number go higher, the national debt, currently at $32.6 trillion. Now, you've probably heard the news that Fitch recently downgraded US credit rating because of things like this. The debt is growing at a faster pace, seemingly an unsustainable pace. And while the deficit has certainly been where we are at today before, we are adding on to a record large pile of debt. And it's worth mentioning that we're doing that by borrowing at interest rates that are higher than they've been in over a decade. But of course, that's not the only data point we need to look at. We need to look at other economic indicators that are leading indicators of whether or not there's pain to come. The main one of these that most economists look towards is the yield curve. This chart represents the yield curve. If the blue line is below the red line, that means the yield curve is inverted. Simply put, that means that long-term interest rates are less than short-term interest rates. With the 10-year yield at 4.2% and the 2-year yield at 4.8%, we currently have a deeply inverted yield curve. The 10-year, 2-year yield curve is not the only metric out there, but all the ones that the major economists look at are all inverted right now. And historically, how steep the yield curve is inverted by predicts how severe the recession will be. Also, an inverted yield curve has predicted the past 7 recessions. And as Game of Trades pointed out on Twitter recently, the 10-year 3-month Treasury yield spread is currently at the same level it was at in 1928. So verdict on the inverted yield curve, yes, we've been here before, but that's not exactly a sign of comfort. What about equity valuations? Because it seems like the stock market is not really doing much about all this negative data. data. In fact, despite a recent sell-off over a couple of days, the S&P 500 is still near its all-time high. One commonly accepted metric of valuation is called the price to earnings ratio. This is a chart of the S&P 500's price to earnings ratio over the last 100 years. It is absolutely above historical norms. And when we pair that with this chart from Crescat Capital, which looks at the correlation between 10-year treasuries and the NASDAQ, another popular stock market index, we can see that over the last year, there's been a severe divergence between the two. Essentially, what we're seeing here is that one part of the market, the bond market, has been anticipating trouble coming up. The equity markets, the stock markets, have not. The bond market, many people may not know, is much bigger than equity markets. There's a lot more money at play. It is also more of an opaque market with less transparency, and typically it's where the big money plays. This means that when the bond market is telling you one thing and the stock market is telling you another thing, more often than not, the bond market is the one that's right. But let's ignore those markets for a moment and look at housing, because very few people own bonds. Not everybody owns stocks, but everybody lives in a home, whether you own or rent. Mortgage rates are basically at 7% now. Last time mortgage rates were this high was over 20 years ago in 2002. So just like everything we've looked at, yes, we've been here before. Interest rates for mortgages have been this high. We pulled out just fine. But what else was going on at that exact same time? This is a chart of the median sales price of a house sold in the United States. As a side note, whenever you see the word average, you always have to ask, is this median or mean? Because it's going to make a big difference on how you interpret the data. To come up with the mean, which is what most people mean when they say average, you just take all of the units, add up the values, and then divide it by the number of units. So imagine you have 10 people in a room. You give 9 of them $1 each. You give the last person $100. If you wanted to find the average number of dollars that people in this room hold, you would take $1 plus $1 plus $1 down the line, plus that last person had $100. You get a total of $109. Then you divide it by the number of people in the room, which is 10, and you'd come up with a mean, an average of $10.90 for each person. But that's a meaningless number because 90% of the people in the room have only $1 and one person has $100. And so coming up with an average of $10.90 per person gives you the impression that most people have somewhere near $10.90, when in reality, that's 10 times what most people have. The other way to calculate an average is the median, in which you just line every single person up in order from least to greatest, and then you pick the middle person out and you look at what that value is. More often than not, the median is going to give you a much more accurate representation of being in the middle of the entire group. In any sort of data set where you have the potential for individuals to have extreme amounts that deviate from the norm by a large amount, median is going to be a much more accurate representation of the overall group. So this chart is the median sale price of houses sold in the United States. In the year 2002, the median sale price of a home sold in the US was $178,000. That's what home prices were selling for the last time interest rates were at 7%. Today, interest rates on mortgages are 7% again, yet the median home price in the United States is above $400,000. Putting together price plus interest rates where they are, again, they've been there in the past, but pairing that with where prices are today, we have the most unaffordable housing market in US history. Yes, it is absolutely true. Each one of these factors is not unique. We have indeed been here before, but we have never seen all of these things happen at the exact same time, and never have they been at the extreme that they are today. And these are just some factors. Add into the signs of a worsening job market, an increasing consumer credit crunch where Americans applying for debt are being denied, student loan payments resuming in October for 40 million Americans, household debt at the highest record it's ever been, with consumers hitting $1 trillion in credit card debt. This time is different indeed, and nobody is prepared enough. If you're an active investor and you'd like to join me in profiting from these coming storms while decreasing your risk, join Heresy Financial University, linked in the description below. As always, thanks so much for watching. Have a great day.